As you may have heard that the talks between US and Iran have failed, the Strait of Hormuz is closed and in fact US has created another blockade on the strait. What does that mean for us? Higher oil prices, higher grocery prices, and higher cost of living. We may be entering an era of stagflation, and in these uncertain times, generally speaking, gold has been a safe haven for nations and individuals. But this time we see gold has seen a dip in the recent weeks and almost lost 23% at one point from its high. So what does this all mean and why the fall? Let's start with the verified facts. On January 29th of this year, gold hit an all-time high of $5,594 an ounce. Silver hit $121. Then over the following 4 days, gold shed nearly $900 an ounce. Silver lost more than a third of its value. The financial press pointed to one headline trigger and moved on. But a spark doesn't cause an explosion unless there's already fuel everywhere. And in this case, the fuel had been building for weeks. In the weeks leading up to that peak, the gold and silver futures markets had become extraordinarily leveraged. Traders had piled into paper contracts using borrowed money, amplifying their bets on higher prices. When sentiment shifted, prices started falling. And then CME Group, the exchange that runs COMEX, the main US gold and silver futures market, announced it was raising margin requirements. For those unfamiliar, a margin requirement is the percentage of a contract's value you have to post as collateral to hold your position. CME Group raised gold margins from 6% to 9% over the following days. Silver margins went from 15% to 18%. What that means in practice? Traders who were already losing money on falling prices suddenly had to post more capital immediately. Many of them couldn't, so they sold fast. That forced selling hit an already falling market, and prices cascaded further down. Here's the number that tells the real story. CME Group raised margin requirements not once, but 6 times in less than 2 months. 6 consecutive hikes. That is unprecedented in modern metals market history. The World Gold Council has tracked every major metals correction going back decades. The same pattern shows up each time. Aggressive margin hikes amplify the paper market sell-off. And both times it's happened at this scale before, in 1980 and again in 2011, prices eventually found their footing and moved decisively higher. The question worth asking isn't just why did gold fall? It's what does a paper market clearing event actually mean for someone protecting their retirement savings? Physical versus paper gold. This distinction is the most important thing in this entire video, so I want to be very direct about it. The gold price you see on your phone is not the price of physical gold. It is the price of a futures contract. A piece of paper representing a promise to deliver gold at some future date. COMEX trades somewhere between 200 and 300 times the amount of physical gold that actually changes hands each year. The vast majority of those contracts never result in anyone taking delivery of a single ounce. This system works fine most of the time, but it also means that when large players need to create a price drop, whether to meet a margin call, shake out leverage positions, or accumulate physical metal at lower prices, they can do it by selling paper contracts that don't require them to give up a single ounce of real gold. Physical gold doesn't work that way. When you own physical gold, a coin, a bar, an allocated account, nobody can force you to sell it. There's no margin call. There's no leverage to unwind. It simply holds its value entirely separate from the mechanics of the paper market. Here's what's significant about the recent correction. While the paper price was falling sharply, physical gold demand did not collapse alongside it. Coin and bar demand held steady. COMEX registered vault inventories were actually declining even as paper prices fell, meaning the physical metal was being withdrawn, not added. The premium for physical silver in Asian markets stayed elevated throughout the paper price sell-off. In other words, the paper market was experiencing a forced liquidation event. The physical market was quietly absorbing. That divergence is not accidental, and according to the World Gold Council, it is a pattern that has repeated in every major metals correction in modern history. Now let's see who is actually buying and why. Here is the data point that I want you to hold on to. The world's central banks bought over 1,200 tons of gold in 2025. To put that in context, that represents more than the entire annual mine output of several mid-sized gold-producing countries combined. And it marks the third consecutive year above 1,000 tons, a level almost never seen before 2022. The World Gold Council projects central banks will buy 750 to 850 tons in 2026. That's a step down from the recent peak, but it's still nearly double the historical average from before 2022, when annual central bank purchases ran between 400 and 500 tons. They didn't slow down when prices were high. They didn't panic when prices corrected. The data shows they treated price dips as buying opportunities, not warning signs. Why? Because central banks don't buy gold as a trade. They buy gold as policy. When a central bank sets a target of holding 20% or 30% of its reserves in gold, it buys at $4,000 and it buys at $5,000. Short-term price movements are a secondary consideration. The emerging market bloc has been especially active. Countries across Eastern Europe, Asia, and Latin America have been systematically reducing their exposure to US dollar-denominated assets and increasing their gold allocations. The US dollar share of global foreign exchange reserves has dropped from around 71% in 2001 to approximately 57% today, a 31-year low according to IMF data. That capital reallocation has to go somewhere, and gold is the primary destination. JP Morgan, with one of the most closely watched commodities research desks in the world, stated in early 2026 that they remain, to use their exact institutional language, firmly bullishly convicted in gold over the medium term on the basis of a structural diversification trend they believe has further to run. Their projected gold price range for 2026 is $4,000 to $6,300 an ounce. At the same time, the US dollar index fell roughly 10% during 2025, its steepest annual decline since 1973. A weaker dollar is historically one of the most reliable tailwinds for gold because gold is priced globally in dollars. When the dollar loses purchasing power, gold prices in dollar terms tend to rise. The dollar has continued to show weakness in early 2026, with the euro, British pound, and several other major currencies gaining ground against it. The structural picture: central banks buying as policy, the dollar under sustained fiscal and monetary pressure, global reserve diversification accelerating, creates a demand floor under gold that simply did not exist in previous decades. Okay, so it's also important to see what the charts are telling us. The macro story is compelling, but it's worth pairing it with what the technical picture is saying right now because the two are pointing in the same direction. The technical analysis coming out of Verified Investing's charts team this week is flagging $4,875 as key near-term resistance for gold. They've identified what's called an inside bar pattern, a period of price compression where gold is coiling inside the range of the previous candle. It signals indecision and it typically resolves with a sharp directional move. Their near-term watch level on the downside is around $3,900 if that resistance holds. On silver, the technical picture is more cautious in the near term. If silver cannot reclaim and hold above the $82 resistance level, the next major target on the chart sits between $60 and $64. On the US dollar index, the DXY, the technical picture is sending what Verified Investing describes as a warning signal many investors are missing. Despite the macroeconomic uncertainty of early 2026, the dollar is not seeing the safe haven inflows that historical patterns would suggest. The DXY breaking and holding below the 100-101.5 zone opens the door technically to a move toward 88, a level not visited since 2018. Here's the point that ties this all together. The macro and the technical are confirming each other from two completely different angles. The fundamental case says sovereign demand is structural, dollar reserve dominance is gradually eroding, and the US fiscal trajectory makes gold a necessary portfolio anchor. The technical case says the near term may bring more volatility and consolidation, but the longer term chart structure is intact and the dollar is showing unusual weakness. When fundamentals and technicals align, that's worth paying close attention to. The pattern we're watching now has played out before, more than once. Silver's 1980 peak and collapse, the 2011 gold and silver correction. In both cases, aggressive margin hikes amplified the paper market sell-off far beyond what the underlying fundamentals justified. In both cases, physical demand held, and in both cases, the metal eventually recovered and surpassed previous highs. The mechanism is almost mechanical. Heavily leveraged paper traders get forced out of their positions. Prices fall to levels where genuine buyers, central banks, institutional allocators, long-term individuals step in and absorb. The paper overhang clears, and then the structural forces that drove the original rally reassert themselves. What's different this cycle is that those structural forces are bigger than they've ever been in the modern era. The U.S. national debt has crossed $38 trillion. According to the Congressional Budget Office, the federal deficit for 2026 is projected at $1.9 trillion on top of the $1.78 trillion deficit run in fiscal year 2025. The interest cost alone on that debt ran to nearly $962 billion in 2025, the largest share of federal spending since 1998, consuming every $14th the government spends just to service what it already owes. Globally, central banks outside the major Western holders still have gold representing only about 11% of their reserves compared to over 70% in the 1950s. The room for further accumulation is enormous. The mechanism that has historically driven gold in the long run, currency debasement, fiscal imbalance, and sovereign reserve diversification, is not a theory anymore. It's an active, ongoing, and accelerating process. Finally, what this means for your portfolio. So, what do you actually do with all of this? Three concrete things. First, understand the difference between paper exposure and physical exposure. If you own a gold ETF, you own paper gold. That's not necessarily wrong. It's liquid, accessible, and tracks the price closely under normal conditions. But understand what it is. In a margin driven paper market crash, it falls right alongside every other paper instrument. Physical gold, allocated, held either directly or through a reputable custodian, doesn't carry forced liquidation risk. Nobody can margin call your gold bar. Second, don't let a violent short term correction rewrite a sound long term thesis. The reason to hold gold in a retirement portfolio hasn't changed because the paper price dropped 15%. The US fiscal trajectory hasn't improved. Dollar reserve dominance hasn't reversed. Central bank buying hasn't stopped. What changed is that a large number of leveraged traders got cleared out of their positions. That's a paper event, not a fundamental one. If anything, the case for gold as a long-term portfolio diversifier, not a speculation, but a genuine ballast against currency debasement and systemic financial risk, is more intact today than it was 6 months ago. Third, think about your allocation, not the entry price. Most mainstream financial planning has historically suggested somewhere between 5% and 10% gold allocation in a balanced retirement portfolio. The reality many retirement savers face is that they have little to no genuine hard asset exposure at all. Their entire retirement is denominated in the same currency that central banks worldwide are quietly moving away from. The entry price matters less than the question of whether you have any real hedge in place at all. Because if the world's central banks are structurally rotating toward gold at the same time the paper market is experiencing short-term volatility, that tells you something important about where sophisticated institutional money is positioning for the next decade. In conclusion, gold crashed, and today gold is sitting around $4,700 an ounce. That's still up over $1,600 compared to a year ago. The all-time high was set just 2.5 months ago. And the structural forces that drove that high, sovereign buying, dollar reserve erosion, debt monetization, global reserve diversification, none of those have gone away. Not one. Thanks for watching. Please like, share, and subscribe to the channel to get regular updates on markets, metals, and more.